Let's get this started. Welcome everybody to our webinar today, powered by Front Range on making books beautiful. This is an exciting topic about a sometimes seemingly dry kind of area of business, financial statements and things like that. But as we get more into it, it can be really exciting. And really the tagline is how financial presentations shape business value, because there is a strong correlation between your financial presentation and your books and what the value of your business is. And so we're excited today to dive into this. I'm Charles Stevenson. I'm a advisor, M&A advisor with Front Range's team here in Boulder, Colorado. And I'm so pleased to have Harold, or Hal as I know him, Hallstein from Sangala Group, join us. He's a veritable expert in this space and a big reason why we're talking about it today. So thanks so much for joining us, Hal. And we'll get into our bios in a moment. But thanks everybody for joining us. And we're recording this, so we'll be able to share it afterwards with anybody that is registered. But pleased to be working with Front Range, empowering entrepreneurs to meet their goals since 1986. Just a quick disclosure, we are not providing advice. We're not attorneys or accountants. So please, this is just kind of educational and informative in nature. So about me, my name is Charles, like I said, and I'm an advisor with Front Range. And why am I qualified to be giving this presentation? Well, I've founded 5 businesses in the United States and Europe over the course of my entrepreneurial career. I've also worked in corporate leadership roles. I've bought and sold businesses and had some exits. I've also founded and operate currently a commercial real estate investment business since 2018 that has bought and sold nearly $100 million in affordable multifamily assets across the Sun Belt and the Pacific Northwest. And I've also been on the buy side from a business acquisition perspective here in Colorado, which is how I happened into this M&A role working with Front Range. So I really understand the perspective that you as a business owner have, having been a business owner myself, managing employees, managing complex and simple revenue models. And I also understand what a buyer is looking for, as I'm a buyer myself. So it gives me a couple different ways and lenses to look at this whole space in this marketplace. Obviously, I'm really passionate about entrepreneurship and investing, as it's been the foundation of my career. And what makes kind of me unique amongst my peers, and frankly, all of you as business owners and investors yourselves, is what makes Front Range as a firm unique. Our entire team, including our leadership and other advisors and brokers, have all founded, bought, and sold businesses. We're also passionate about entrepreneurship and supporting entrepreneurs. And that passion has fueled our growth since 1986. We're one of the largest M&A firms operating in the United States. We have supported thousands of business owners right here in Colorado and across the US. We've helped them plan for their exits. We've helped them actually transact and exit and retire and move on to their next endeavor. So our close rates are higher than our peers. We have a quality-focused approach. We only work with a few clients in a period of a year, each of us, and we work as a team with leadership involved throughout. Our brand promise is to help you achieve your exit goal, whether that be growth or maximizing your business value or making an efficient exit, preserving your legacy, or some blend of those things. That's our brand promise to you, is to deliver on that goal. And we deliver. And that's why we're commonly referred to by banks and other lenders, wealth managers, attorneys, et cetera. So anyways, pleased to be here with you all and dive into this important topic. I'm also really pleased to introduce, like I said, a good friend of mine who's also one of the smartest minds in this space, Hal Hallstein, the founder and principal of Sangala Group, who's been managing family institutional wealth for a while, for decades. Hey, Hal, why don't you jump in and share a little about who you are?
Thanks a lot, Charlie. It's a pleasure to be here with you all. I certainly have been fortunate over my career in the last 15 years, which has largely been helping families and individuals make investments and manage their wealth, to work with Front Range in business sales and have a number of clients who are completed business sale essentially clients of both of our firms. So it's an honor to be here with you today. Hopefully I can bring some of that lived experience, both working with people buying businesses and those who have sold it and become wealth planning clients, to paint a picture of some of the ways that we can enhance and create value for people who are selling businesses.
Great. Thank you, Hal. And, we'll get into an agenda in a second, but before we do that, we do tend to go off script here and there. And I think that's what's fun about making these conversations a little more lively, but Hal, let me just tee up the general theme of today with a question. When owners start thinking about an exit, oftentimes their main focus when we begin talking with them is really about finding a buyer. Like, do you guys have a good buyer you can bring to me? And that's great. That's fine. That's a critical part of this whole process. But in your kind of experience, what's one of the most single critical shifts they can make in their approach and where they start thinking about where they need to be preparing themselves for a go-to-market?
Well, at the highest level, the very best outcome for an individual selling a business is to be faced with multiple potential buyers who are all interested in acquiring that business at the same time. In my experience, one of the best ways to achieve that really positive result is to have the financials of the business, which are the primary documents often presented to potential buyers about a business, working in such a way to increase the sense of trust and confidence in multiple buyers. Because if you have multiple buyers confident and trusting in the prospects of that business, your chances of achieving this multiple buyer bidding scenario is higher. Those are the situations where value is really maximized for people selling businesses.
Yeah, beautiful. Yep. So it's not about finding the buyer, it's about preparing yourself so that you have the most attractive financials and the most attractive story for your business that will attract many, many buyers. Buyers aren't going to be an issue if you've got the right foundation in place, which really starts with beautiful books and financials. Just to follow up on that, Hal, like what would be left on the table? Like if you did choose not to make changes and present your financials in the most beautiful way, what kind of value are we talking about here?
In circumstances where disorganized or unclear financials are presented, it often limits you to perhaps a single buyer who's really confident in their ability to straighten these things out, reorganize them, and fix them themselves. It's a much better circumstance for multiple buyers to be very confident about the potential prospects of the business, whether it be growth in revenue, growth in earnings, or the ways that that business can be improved and enhanced, such that they're tripping over each other in order to try to buy this business. They're seeing it as an opportunity worth competing for. The financials are the first thing that a potential buyer will be looking at. And it's sort of like when you're introduced to any new person in your life, they're going to make judgments based on the appearance of what is in front of them before the content. We're just attempting to utilize that bias in human thinking to make sure that first connection moment with buyers is creating the most optimal circumstances for multiple people to think that your business is worth acquiring.
Yeah. So just like distilling that a little bit, imagine you only have one buyer who is looking at your business and there's nobody else and they know that. They're going to be thinking, well, the price is $1 million. I don't see anybody else in the room, so I'm going to loft a $600,000 or $700,000 offer at them versus there's multiple buyers in the scenario. The price is $1 million and there's a scarcity that gets created and they're all saying, well, I could offer $1 million, or if I really want this thing because it's really attractive looking, maybe I offer 1.2, maybe I offer 1.5, who knows? So a substantial amount of value could be left on the table. And we'll dive more into this in a second. But today's kind of agenda and key takeaways, really what we'd like you all to leave today with is a better understanding of what your books frankly are. When we talk about books, what are they? We're going to start with the most basic ideas here, guys, just because, there's a whole host of understandings of these things. Some people have bookkeepers and accountants that do this work. So business ownership, who is ultimately the seller of the business, might not have the granular understanding of the importance of these documents and why they should be really familiarized with them. So we're going to start the basics. But today we want to leave you to leave with kind of I want you to understand what your books are in the context of selling your business and why they play such a critical role for exit planning, for valuation of your business, and for that sales process. And further, we'd like you to walk away with a few simple actionable steps that you can begin to take yourself as you contemplate your exit to make them more beautiful. And likely, lastly, we'd like you all to see myself, Front Range, and our greater team, and Hal as a host of resources that you can draw from, as you continue to move down this path of planning for growing and or exiting your business. And we'll give you some different ways you can engage with us. We have this great exit readiness assessment that helps you to start to see and identify both strengths and gaps in your go-to-market plan, including your financial preparation. So we'll share that link with you at the end of this so you can take time to begin that and interact with us. But anyway, the agenda essentially is we'll jump into the buyer's perspective when they start looking at your financials and start looking at your business, and that first impression. We'll kind of get into their brain a little bit. We'll talk about the very basics, of preparing your financials so that your business is first and foremost sellable. There is a question mark there if you're not organized with your financials. We're then going to talk about how you tell a great story with your financials. Like, how do you make that kind of boring spreadsheet actually kind of exciting? We'll talk about a really great framework that Hal uses called the 3 vectors of excellence. This is the things that you can do to your books that make them more actionable for you and make your business more demandable in the marketplace. We'll talk about advanced concepts that build on top of the basics, like that really increase your business's valuation, not book value, but valuation. And we've got a case study we can talk about, a transformation story, taking an ugly set of books and making them beautiful and showing kind of what the impact is. And finally, we'll put a little action plan out there for you so you can see, okay, here's my next 5 to 7 steps that I can take to get my books into a good spot. And then again, some information about how you can engage with our team and resources. And there's a Q&A in there as well. So if you do have questions throughout the course of this conversation, please don't hold back. You can either raise your hand. We have an administrative staff who's awesome on the side here. You can also put questions into the chat box, and they will help to feed that to us so we can work those questions into the conversation in a natural way. If we find the question is better suited for the Q&A section, we'll handle it there. So just thanks for your patience, and please don't hold back. This is meant to be an educational resource for you. So anything else, Hal, that you'd like to add in terms of like 1 or 2 really critical key takeaways that people should have today coming out of this meeting?
I think we want to focus on making this really actionable and practical for your use. So we hope to be concise in our presentation. And like Charlie said, please put any questions there.
Yep, great. Okay, so why do your books matter more than you may think? It's not just a tool for tax filing and keeping things organized so you don't get in trouble with the government. Like, books matter in a significant way, especially when you're contemplating an exit. And this kind of first section here what are your, when we're talking about books, like what are we talking about here? And how, like maybe you can just decode that a little bit. Like, what does books, mean?
The books of the business could be defined kind of broadly. And during a business sale, you may be asked for all manner of documents, but primarily there's certain books which are always asked for. Those are the profit and loss statement, the balance sheet, and potentially a statement of cash flows. These are basically the documents that describe in any given accounting period, most often a calendar year, how much money it is that your business did or did not earn, and what the value of the assets that are being utilized in that business are or are not in any given period of time. I have never seen a business sale that did not require these documents to be brought to the table. And most often, particularly the profit and loss statement would be the very first document presented at the top of the stack. That's why it's so important that this document is thoughtful and well considered. It also is a document where generally they're going to ask you for 3 years of versions of it.
Or even 5, or even 5, yeah.
Or even 5.
Yeah.
The best preparation actually needs to begin well in advance of a business sale to do an optimal job. And it's, our main goal in this presentation today to make sure that profit and loss statement, those people on the call understand what makes one that's truly great and confidence inspiring, that can move a business sale fast and quickly to a good resolution, versus what makes a sort of less inspiring book. So in our case, just again, for us, we're talking about the profit and loss statement, the balance sheet, and in certain circumstances, a statement of cash flows. Last but not least, we're also talking about your tax returns, which is basically how the government interacts with those financial statements. That's also very important in any small business sale, because people use the tax return to verify a lot of the truth that's being told in these other financial statements about the business.
Yeah. Thank you. That was an awesome encapsulation of it all. And like, really, when we're talking with buyers, what they really are asking for is, the P&L, the tax returns, 3 to 5 years. And why 3 to 5 years? There's a couple reasons. 5 years or 3 show trends. Trends are really critical. People want to see growing trends in income, growing trends in earnings, maybe decreasing trends in cost of goods sold and overhead. So that gives them the ability to see that. The other thing is, the minimum of 3 years is requisite, because when we're talking about buyers here, we're also talking about another stakeholder, who is the lender. The lender is the person that's, or the bank that's going to be establishing a loan that often helps buyers buy your business. It's uncommon to find businesses in the lower middle market, which is this space of under $25 million in value, selling without some kind of debt on it. And so lenders require minimum of 3 years of tax returns, minimum of 3 years of profit and loss statements. And the other thing about that is, besides showing trends, the way that valuation is done is with at least 3 years of profit and loss and tax return statements, because what they do is they average those in order to get a better sense of the overall earning power of that business. You might think that you just need last year's to get a sense of where the business is and what its earning capability is. But and there is a lot of truth to that. You could have an interesting philosophical argument or debate about that. But the way that valuation is done, and the way that your valuation is calculated, is they take a weighted average of the last 3 years. Usually it's like 50% weight on last year. So 2024 would have the highest weight. The previous 2023 would be 30%, and then 2022 would be 20%. And they average those 3 years, and that gives you, of your earnings, and that gives you kind of an earnings number that then anchors your valuation. And your valuation is calculated by applying a multiple to it, which can range anywhere from 1x, just your earnings as the price, to, boy, the sky's the limit these days. But in lower middle market, we're usually talking around a 3x. One or potentially for high performers or certain sectors that private equity like, it could be up as high as a 4 or a 5. So you're taking that earnings number that's been averaged and multiplying it by that multiplier, and that gives you what your value is. So these numbers are really critical for establishing valuation. And just to say it straight up, if you're unwilling to provide your tax returns, especially, a bank's not going to loan on your business, which could make you non-financeable, which could make your business not sellable, or very difficult to sell. So anything else? The last thing I would say is like that, you might think that the buyer is really buying all the things that make up your business, your website and your brand and your reputation in the market. And that is true. But really what buyers and investors are looking for at first is they're buying your book. They're buying your books. They're buying your income potential, your earning power. That's what really they're buying. And everything else is almost ancillary to that, at least at first. So anything else, I think talking about, that first impressions, I think touching on that again, how would be good. What kind of a first impression are your books going to make one way or another?
The most common impression it's going to make is either we are organized and on top of our business, or we are disorganized and a bit lackadaisical. Of course, it's going to be beneficial for you selling the business to show that you are on top of your business. Strategically speaking, there are certain scenarios where showing yourself as not fully organized actually can be better than fully organized, but that's an advanced concept we'll deal with later in the presentation, perhaps. In general, what you want your books to do is communicate that if my financials have been handled with this care and consideration, then the buyer will assume all other elements of your business have also been handled with that care and consideration, which basically puts a higher level of trust and confidence on the table early in the discussion, which can only move a sale process faster, easier, and basically make it more effective.
Yeah, no, that's good. That's a good point. So besides just having an impact on valuation, a well-organized book can have other kind of qualitative benefit, like a faster time to sale, more enjoyment going through the process and not having certain buyers fall out, like sticking with that one buyer through the whole close. So And
Charlie, just as a quick sideline and a joke,
yeah.
when renting a place to a potential tenant, often you hear people say, "I like to go out and look into the tenant's car." Because they're
Mhm.
going to tell you that they're clean and
Right.
take care of everything really nicely. But perhaps by looking in their car, you're really going to find out who they are. Your financials are essentially the car in this
Yeah.
scenario. So we
Yeah.
encourage you to get them in order before you present it to somebody to buy.
Right. So it's a very personal demonstration of how organized you are because it's usually totally undisclosed to anybody in the public until you get to this point. And so you could have them be messy. You could have a messy closet. So ultimately these things build trust. Buyers are going to be asking, what can I trust these owners for, and are there stable or growing earnings? Hal, like, let's get into the buyer's mind for just a minute. What are they looking for? Like, what are they scrutinizing when they're looking at this set of financial documents?
Well, first and foremost, people who are buying a business are looking for earnings, positive earnings. The reason they want to acquire a business from you is that they think it's going to add to their own life's economics. Also, in the particular space that Front Range works in, people are often looking for businesses which are financeable, meaning they're seeking ways to buy the business without paying for it 100% in cash. That really requires the books to be organized because they not only have to win the confidence of a potential buyer, they have to win the confidence of the buyer's banker or financiers. So that's another reason why having them be strong on the first impression will move this whole process so much faster.
Yeah, great. So they're looking for things like cash flow and strong earnings. They're looking for things like red flags. They are, clued in, looking for issues in the financing model or the financials. They're looking for things like normalizing adjustments, like, besides the net income at the profit at the very bottom, like what else would I enjoy as the owner? Oh, there's trucks, or there's a vehicle, or there's health benefits, or there's owner's salary, owner's compensation in the general administrative expense. I'm going to add that to the bottom line to get a total idea of what this business is going to produce for me as the new owner. So maybe the net income shows, 300 or $400,000, but there's 150 grand in a salary to the owner's compensation. They're going to add that down there, and all of a sudden that business to them is worth $550,000 in earnings a year. So they're going to be looking for stuff like that.
Yep. On the
Yeah, go
more
ahead.
qualitative side, in my experience, often too, you'll find interest in buyers and businesses that have a history of good revenue growth that perhaps tapered off. And they
Sure.
believe that the seller has perhaps gotten older and is just not working as hard on the business, and that they somehow can bring new energy and bring that level of revenue growth back to where it once was.
Yeah.
Maybe they also see a way that with their skills, perhaps they're really strong with a computer and they're looking at a business that was run with maybe less technology to lower the cost of overhead and increase the profitability of the business from where it currently is. So
Mhm.
generally speaking, they're going to be looking for businesses that have earnings, A, and that B, those earnings can be enhanced in some
Mhm.
way.
Yep.
And your ability through your financials to tell the story or hint at how those earnings might be enhanced is really the recipe for getting multiple bidders and enhanced valuation.
Yeah, great. Beautiful. Okay. So because I said we're going to start with the foundation of the basics, this next slide is really just the basics. This is an organized profit and loss statement, a P&L, as it's known as, or an income statement. So this is your organized one right here with the most simple kind of hierarchy imaginable. Do you want to pontificate on this for a moment, Hal?
Yeah, as simple as this slide is, there's actually a lot to be learned from it. So I'm going to just take a moment and do a few observations. What are we looking at? We're looking at a profit and loss statement, and we're looking at a well-organized one. I say well-organized because first off, you'll notice that this statement shows only dollars and no cents. One of the first common errors that I'll see people make when you're selling a business to be reporting down to the cent on these various buckets of income and cost is nothing but a distraction. It really doesn't enhance the conversation. It makes the report much wider, noisier. It prevents you from getting multiple periods on the same page. So step number one, I would say, to making your books beautiful is utilize the software or the spreadsheets you're using in order to round the numbers to the closest near dollar. We know that's okay because if it's good enough for the IRS and your tax return, it's also good enough for your books. Other things that are notable and positive here is that I see that each of the categories that revenue and expense are broken into are actually intelligible. Um, I can understand maybe perhaps with the exception of the line that says other G&A, and one would have to know general and administrative is what G&A stands for. In general, each of these accounts is named in a comprehensible way. I see that they're capitalized. There aren't misspellings. Um, in general, that is something you really want to get towards. Using acronyms, having misspellings, poor capitalization, also very commonly seen in people's books, and very easy to correct in ways that will go back and adjust into all the prior years. Other fine points that are really critical, if you look in the area called operating expenses, you'll notice that they're organized from largest to smallest. So salaries and wages of 350,000 appears well above office and IT at 25,000. This is really important. There actually, I do see one thing that I would describe as suboptimal on this slide, and that is installation revenue of 2.4 million is found below service revenue of 1.2 million. In general, the largest numbers should be coming at the top and the smallest numbers should go at the bottom because you're trying to get the buyer to see the biggest, most important things right away. One other fine point that I'll say that you're seeing on this slide that you have on this slide is actually an omission. You don't see categories with very small numbers, $25, $35, or even zero values. On this particular P&L, everything has found a home in a bucket that matters. It isn't causing you to read things that are inconsequential or not important to your decision making as a potential analyst or buyer of the business. So everything that's there has some material dollar amount. Last but not least, you'll note down in the other income and expense area at the bottom that certain types of expenses and income, those which relate to financing particularly, so interest expense, which is interest paid out and or interest received, perhaps that in the miscellaneous income, that could be interest received or perhaps cash back for credit cards, has been broken out and put in a separate section so that it can be talked about distinctly. Also,
Right.
you'll note that this particular profit and loss statement has an area called cost of goods sold, where the particular expenses that are required in order to create the product or service delivered to the customer are put in one category. What this allows you to do is arrive at a gross margin calculation, which is essentially a ratio that helps you delineate between general ongoing overhead in a business and the actual costs to deliver the core product and service. We'll get into this a little bit more in a second, but in this particular statement, that's been broken out in a comprehensible and intelligible way.
Great.
So there's a number of things that have been done very well here. I will note that this only shows a single period in time. It's often when you're presenting a business to be reviewed by buyers, we're going to show multiple periods in time. So you'd see additional columns. It's my recommendation that you put the most recent period on the left, closest to the label for each account. Once again, because you want the buyer to be focusing on the most relevant, most recent information. And so in my general opinion, that is the strongest way to present those financials. One other fine point, if you use your imagination for a second, often people show me profit and loss statements where they're trying to show the change between one year and another. Sometimes they'll show that change in dollars. I really recommend against showing it in dollars. That essentially requires the viewer to have to do math themselves to say, hey, was that change a big change, a medium-sized change, a small change? Instead, I encourage you to show, if you're going to show change between period, to use percents and only percents. Save the room on the report for dollar change. All one really needs to know is what percent a particular category has moved from period to period to make really good, strong analysis and decisions about those things. That's another way to keep this very clear and concise, using percentages to show your year over year differences.
Beautiful. Thank you, Hal, for walking us through that and breaking that down for us. So we'll touch more on each of these little topics.
Hey, Charlie,
Yep.
sorry to
Yes.
interrupt you for a second.
Asma,
Guys,
yes.
please let us know if you can see the slides, because we have someone say that they are not seeing any slides. So it would be helpful if you guys can let us know if you can see the slides.
Yeah, is anybody having any issues with viewing the
Yeah,
slides that
please let
we're
us know.
presenting? Just go ahead and message in the chat and we'll QA that. We'll figure that out for you.
All right, thank you.
Thanks. And apologies if there were any issues with visibility, y'all. We had a few people kind of start after we had begun, and I think there might have been something with the viewability if you came in after the start. So, but Sufyan and Asma, our administrative staff, will help you work through that. So thanks for your patience. Okay, so moving on into the basics. So I know we've been talking a lot about the basics already, but you know, it's funny that we need to bring this up, but often we work with clients and we say, we'd love to have a look at your financials, and they say, where should I mail them to? And this is challenging. If you're not digitized, it's going to make the process much harder. And so we said, let's start with the very basics. Digital reporting, guys. You know, if you're not already using QuickBooks or some other similar platform, that really should be, that's the best practice at this moment in time. If you have paper ledgers that you're working off of, start working on digitizing those. It's going to make analysis easier. You know, the next point on the basics is disclosure. We already touched on this, so I'm just going to briefly mention it, but you need to be able to get comfortable with sharing your tax returns and these financial documents, these P&Ls. If you're not willing to do it, or if there's something you're hiding in there and you're not willing to provide them, you're likely not financeable, which is so critical during this process. So disclose the truth. You know, I think one last thing I like to ask about, like kind of the basics, is there is a pitfall that we see many business owners make, which in most stages of the business life cycle is actually really great governance. So let's talk about what that is. Hal, this unique question is using tax strategies to lower taxes good when you're operating a business?
It's a great and nuanced question, Charlie. And of course, we're trying to avoid paying any taxes that are not required under the law to be paid. That being said, many business owners really bend over backwards in their tax saving strategies. This can be great for the majority of a business owner's career, but when you're into the window where you're thinking about selling a business, it can really work against you. And the best way to understand how it works against you is you're talking about multiples of earnings in valuations of companies, and perhaps they range between 1 times earnings to 3 times earnings, or perhaps even 5 times earnings. If you figure out a cost saving or tax saving technique that lowers your earnings $10,000 in 1 year, and that business is going to sell for 5 times earnings, you've actually just lost up to $50,000 of potential sale value. So as we move into the period of time that you're selling your business, it's very important that we're maximizing the earnings of the business, which, you know, is also potentially going to maximize the amount of tax being paid by the business during that period of time. But that will be paid back multiple fold, literally by the number of times of the selling multiple. So as we get into this period of time where you're marking your business, we're trying not to pay any taxes that aren't due under the law, but we're also not seeking ways to make our business show less earnings on our tax return. That's a nuanced discussion with every business, but in essence, that's what we're looking at.
Yeah. So, do your best to almost maximize earnings as you approach, your exit window, and that could be a year, 2 years, 3 years out. This is only going to bode well for you when you're, figuring out what your valuation is going to be. So, those strategies of buying a new fleet in December or realizing as many materials costs in December because of pricing benefits for a project that's happening, that coming March or February or whatever. Try to hold yourself back from utilizing those mitigation strategies. It's great governance. It really is. And it has been for decades as you operated and built your business. But as we approach that window, we want to be maximizing earnings. It's going to be better for you. So let's talk about crafting your financial story. We've been talking a lot about the first impressions and things like this, but what kind of how do you make your financial story compelling and easy to read, and certainly one that people are excited to see themselves buying and operating. If you could talk about this for a moment, Hal, a clear story of performance, growth, or both is something you really want to show in your financials.
Yeah. So I did just see a note. Somebody asked, why not pro forma that stuff about our conversation before? I just want to address that quickly and say, in my opinion, most people buying a business are going to put any pro forma, which is essentially a non-factual or perspective future look at the financials. They're going to take that and put it aside, and they're going to attempt to use it as a negotiating tactic against you. It's not to say it's a bad thing to do and it can't work, but most commonly we see pro formas discounted relative to the actuals. And each business is a case-to-case scenario. That's a great question. And there is a time and place for that. In general, having it show up in the real final closed financials of the books is important.
Yeah. Yeah. Just to end further on that, valuations are going to be based upon actual financial reported data, literally your tax returns, and that's what is going to be mostly factored. Banks will not consider pro forma information, at least definitely not in the lower middle market, which is businesses that are under $25 million in value, which is the majority of the businesses that transact. That's 98% of the businesses in the United States. So unfortunately, pro forma can help to build buyer demand if you can show work in progress reports and project pipelines, exciting project pipelines that could extrapolate earnings into the future. That might increase demand for your business, but it's not going to result in, it's not going to be a lever for valuation in the most typical methodologies for calculating valuation. And banks won't care about it either. So they just want to know that you're going to be able to cover the debt service. So. But it's a great question. I'm glad you brought that up. Thank you. So back to it, and just being clear on time, we need to start moving a little bit because we've got, only 23 minutes left. And we want to leave some time for QA. So maybe we'll just kind of knock through these quickly. Hal, do you want to mention a little bit about kind of organizing financials with that clear hierarchy? I know you did talk about that a little bit in that previous slide, but is there anything else you'd like to mention?
I feel like we covered this well.
Yeah.
The one thing I want to highlight here about standard business and accounting language, the names of the various buckets and accounts that are used in financial statements is called the chart of accounts. And the chart of accounts is a powerful place where you set the names for those buckets. One thing I do want to note on that is that the language chosen there, it's very common for me to see weak language in businesses that are being marketed for the first time. And it's also one of the easiest things to fix. In a few hours, it can really be enhanced. So picking the language to best highlight what those buckets are is low-hanging fruit and a very common problem that does need to be solved. And good guidance along the way. If you're not comfortable doing that yourself, a lot of people can help you with it, but it really does enhance the clarity, conciseness, and confidence factor of your financials. That would be the one thing from that slide that carries back.
Yeah, and there's one other idea which I like when we're talking about working with clients. You often mention this phrase, "Show me the turkey." What do you mean by that, Hal? When you were talking about looking at the financial statements.
Often in a business that has multiple sources of revenue, it's really important that the large one, the most important one, or the one that has the best durability or perhaps growth, is named or highlighted in such a way where attention is drawn to it. It's that seems obvious, but in practice, you see it done poorly often. And so what you're trying to do is use the chart of accounts and naming to get the buyer to instantaneously understand where the opportunity, the turkey, is in that particular business. And you use that with language and appropriate naming. You'd be amazed how often I see sort of weak naming in revenue buckets. It's one of the easiest things to fix.
Yeah. And you can just make these changes right in your chart of accounts in QuickBooks, simply enough, like making it understandable. And there's a litmus test, which is, can a non-expert, someone who doesn't really look at financial statements that often, look at this thing and understand what's going on? If they knew this was an HVAC business and they looked up here and they're like, okay, installation revenue, that's installing HVACs. Service revenue, that's servicing those machines. Maintenance contracts, that's a contract that obviously, continues over a yearly or multi-year time period that helps me to generates revenue based upon that service work. And so like that maintenance work. And so showing the turkey up here, maybe this is the most recurring revenue, service revenue. And then installation revenue is also sizable, but it's only project based. And so leading with that particular turkey up there, that shows the most interesting and compelling kind of opportunity to the buyer. So I just made a mess with this.
Charlie, since time is limited, should we go to our slide where we've kind of executed an example of that to paint that picture? It is the most important idea of the day.
Yeah, I think we should. I think the 3 vectors of excellence, though, we'll get there. It's 2 more slides away. Yeah.
Great.
So all these different ideas, guys, ultimately support the buyer and their lender in understanding your books and understanding the compelling buy opportunity. But I think there's something that has been missed a little bit, which is this isn't just for them. This is also for you. If you can organize your books in a really beautiful way that make for a really understandable picture of what's going on operationally in your business, financially speaking, that's a great tool for management. I think, as I was getting started in my own in my own entrepreneurial journey, I didn't often use my profit and loss statements as a management tool. And now it's something I couldn't imagine not using in my even day-to-day or certainly weekly and quarterly reporting. So it's a great tool for management. Of course, it makes analysis and due diligence so much easier for the buyer and their lender. So that really speeds things up, decreases questions that then you have to explain. And it just, again, signals organization of if your financial house is in order, then probably the rest of your operations are decently in order. Your employees, your revenue models, your client relationships, et cetera. And then the simplified tax filing idea, how you share, if you've got maybe you share like when you've got a smaller business and they're trying to figure out how do I organize these chart of accounts, what do you typically advise them?
Yeah. So the IRS is a stakeholder in your books and financials. And the ability for your CPA, if you use one, to translate your profit and loss statement and balance sheet into a tax return is really important. When I work with people who are really just starting businesses, I actually often go straight to Schedule C, which is the part of the an individual tax return where businesses report their expense. And I say, use these categories, which is shown here by the IRS as how they want to see it reported, as the actual categories you use on your profit and loss statement. Why? Because when you go to fill out your taxes, you literally will have no work other than moving the number from one place to another. No thought or creativity of recombining things is required. That can't happen for most businesses that are a bit more complex, but certainly one vector of excellence, a vector meaning a direction of push on your financials, is making sure that it's easy to move from your management tools to tax filing. So that's one thing I'm always looking for. Has this been set up in such a way that it's thoughtful related to how it has to be reported for tax? Quickly going over, you talked about the financials being a tool for management. It's also a tool for bankers to formulate ratios which they use to deem how much they're willing to lend you in a certain case. It's a little beyond our scope, but the financials can be better or well or poorly set up to make those ratios jump off the page. And in my direct experience working with bankers, if you provide them something where the ratios they need jump off the page, their enthusiasm to lend to you is higher. If they have to do more work themselves, their enthusiasm is lower, and therefore that's a vector of excellence as well.
Right, great. So we're going to go through these advanced concepts really briefly because we want to have some time for Q&A. I see a couple questions there, but the advanced concepts are more about revealing hidden value and increasing your valuation. And this is, Hal, you touched on this a bit already, but doing margin work, ensuring that your costs are in the right buckets so that your margins show performance relative to your peers in your industry. So that's the idea, is like making sure that costs are being job costed and labor costs are in the right spot and not being lumped in with something that that will skew your margins one way or another, making your business look like a poor performer. Anything to add to that, or should we move into the accounting? Anything you want to add to that?
Just really quickly, the thing you want to keep your eye on there is the difference between what they know as gross margin and net margin. The net margin is essentially the percentage of the amount of money that was earned by the business relative to its revenue. Often you find, most businesses, at least publicly traded companies, you're going to find between 8 and 12% on net margin. That is differentiated from gross margin. The reason that is done is that the best businesses don't have to expend new investment on overhead, so administrative staff, computer software, etc., that they have to spend to actually create the products and services that they'll be selling. That is why people like to look for businesses that can be scaled well. If you can grow the revenue faster than the overhead grows, as measured by a percent year over year, what you actually end up with is an expanding net income margin. It's very easy to get your P&L to show both of these margins, and often a great way to demonstrate the value of what you're trying to sell is showing the buyer how that can improve, or if it has already been a history of improving, illustrating that clearly.
Yeah, beautiful. Yeah. The last two topics and advanced concepts are looking at your accounting procedures and ensuring that you're using the right accounting procedure for that best fits your kind of operational needs. So there's cash and accrual accounting procedures. We're not going to go into the details of these right now, but essentially, as your business grows, accrual makes oftentimes more sense, especially if you're a business with commercial revenue and commercial projects that span over multiple years or over, like a 16-month period. Having an accrual reporting basis or reporting methodology ensures that the income related to that year is reported in that year and the costs related to that year are reported in that year. And that can really have a dramatic impact on your earnings and ensuring that they are being conveyed in the way that's most clear and most obvious for the operations that you have. And that can really make an enormous difference on your valuation. If you've got, income being reported in the wrong year or costs being reported in the wrong year, that can really have an impact. And quality of earnings, we touched on this a couple of times, but not all income is equal. Recurring revenue, contracted revenue, multiple year revenue is more valuable in a lot of ways relative to just project-based one-time revenue. And so there are different treatments for valuation based upon whether that revenue is recurring and sustainable and evergreen versus, project-based one-time revenue. So these are things that you can really think to accentuate in your naming your chart of accounts. And we'll talk about that in a moment when we get to that example that Hal was alluding to earlier. So let's just jump right to that. Sound good?
Great.
So the transformation case study, let's try to do this in 2 minutes because we have to leave some time for Q&A and some follow-up action stuff. So tell us, why don't you just quickly work through the high points of this?
So Charlie had his red pen out a moment ago where we were talking about how naming of accounts matters. On the left, you have ugly books. On the right, you have beautiful books. And we illustrated what some of those changes might look like. In this particular case, this business is installing and maintaining something probably related to people's homes, let's say. When it came to us, it had a name of miscellaneous projects, 800,000. We're going to clarify that. We're going to call it project installation revenue. It had other service income. This was really unfortunate because we actually found out that these were maintenance contracts with some legal authority to them, which really assures the buyer that there's a consistency of this revenue. So the name should be changed from other service income to maintenance contract revenue. We also noticed that there was a little bucket that was called measure processing fee. It was $255. It's a total distraction. We figure out how to put that in another bucket, remove it, and take that as a potential question or point of focus off the table entirely. Last but not least, there was a really esoteric entry called unapplied cash payments. Basically, we could read that as somewhat lazy or behind the times bookkeeping. We actually addressed that, fixed the problem. We realized it's annual recurring service contract revenue, and we labeled it in a way that's much more intelligible and enhances the sense of the recurring nature of that particular revenue.
Yeah.
Similarly, we found that certain seasonal salaries that were involved for the installation of these projects was being shown in overhead. We, by moving it to the cost of goods sold and kind of incorporating it more into gross margin and less into the net margin, have better painted the picture to the buyer of, hey, these are the costs of the professionals required to install windows or doors in this particular house, but it's something that is going to be fixed for the amount of projects you do every year. It shouldn't show up in overhead because that takes away from the sense that we're going to gain scale. You're not going to have to hire a whole bunch new accounting or front office staff in order to enhance the amount of projects you install. We make that clear by moving those project costs and salaries into the cost of goods sold area. This also clarifies it. The results that you end up seeing here are perhaps our gross margin goes down after the books have been beautified. That's actually a very good thing because we painted a picture to the buyer that we're getting scale in terms of the overhead of the business, meaning the overhead isn't growing as fast as the revenue is growing. Now, the net income of the business and its margin, it stays the same. There hasn't been any change. But what we're telling you in this presentation today is there's a good possibility that you might be able to sell the more beautified business for 2.5 times earnings, or perhaps $500,000 versus 2 times earnings, which was $438,000 in this case, because we've been able to show the potential buyer that there is recurring, highly predictable revenue here with contractual underpinnings, and that there is scale and economies of scale occurring in the overhead of the business. To be able to demonstrate that alone, that could have value potentially close to, in this case, $62,000, very material for the seller of a business. And all this is work that we think can be conducted perhaps in a single workday in some cases. Often it takes longer, but we really want to show you how the work of beautifying your books actually can put money in your pocket in the sales process, and it is worth doing and thinking about.
Definitely. All right. Thanks for walking through that case study. So key takeaways, guys: digitize and organize your financial statements. Know the current story they tell, and what that may be good, that may be bad, that may be something that's neutral, who knows, but know that story, be familiar with it as the manager of the business. Avoid decreasing earnings for tax breaks while you're planning for your exit. Work with a solid team to improve your books by telling a clear and compelling story. Begin to change, make changes to increase the conveyance of a strong story. Align your financials with those 3 vectors to convey excellence to all the different stakeholders that are going to be looking at that books, including yourself. Simplify naming conventions and hierarchy for income. We talked a lot about that today. Highlight your margins, highlight recurring revenue, and use correct accounting methodologies for operations. And lastly, work with a solid team to plan your exit and go to market. We're here for you. We do this all the time. We love working with clients on these types of projects, and it's a critical part of the exit planning services that we offer beyond our transaction services at Front Range. So, the highest level is if you've got clean and organized books, you're going to have a higher valuation and more demand for your business. Preparation prevents deals from being killed or not financeable, and simple changes can have a really outsized impact on your valuation. So don't try to have to remember all this from the conversation today. Of course, we'll share this with you, but if you want to learn more about what we do and how I'm working with clients literally right now on this very process. We're here to help you. We've got a really amazing stable of professionals like Hal and our own team internally who do this work of making books beautiful and prepare you for exit. So before we open up for questions, I just want to say, if you guys want to get started in working with us in some way, we have a few kind of in-kind or free resources that we can offer you. We have an exit readiness assessment. This exit tool is linked right here. You can click that and it opens up, takes about 5 minutes to go through that. It'll help you to start to establish what the strengths are in your particular exit strategy are in your business, what the weaknesses or gaps there are, including kind of in your financials. And that just starts to bring some intentional awareness to where you currently are for an exit or for exit planning services. And we'd love to schedule an introduction meeting to discuss how we can meet those goals. There's a calendar booking link right here that's underlined. I think also our team will put that in the chat. You can always give us a call. We're here in Boulder. Happy to meet with you in person, talk through this kind of stuff as well. You can always connect with me. That's my direct cell, and that's my direct email address. And our team is happy to jump in and start working with you to make those books beautiful and figure out how to maximize your valuation in the marketplace or achieve whatever that goal is that you have. That's our promise to you. So with the last 5-6 minutes of today's conversation, first of all, I want to say thank you all for being here. Thank you so much, Hal, for coming in and providing your expert kind of opinions on all of this. And so great to have you as a colleague. If you guys have any questions, let's open up the discussion for the last few minutes that we have. I also can stick around for a few minutes. If people want to stick around and ask more questions, we can do our best. You can submit a question in the chat window, raise your hand with that little raise your hand icon in the top toolbar. You might also just be able to speak up. I'm not sure, but that's how we can get this started. So first of all, are there any questions that are already in the queue from before? Looks like Mina had a couple of questions related to taxes. Pro forma, why not pro forma tax issues? That's a great point. Pro formaing tax issues and doing your best to kind of try to understand your tax liability going into exit is a critical thing to be done. Looking at net proceeds and how we identify different assets and their attending tax liability is an important part of this process. I don't know if you're a tax expert, Hal. How would you kind of talk to why not pro forma those tax issues, and is there not really sensitivity for small businesses maximizing tax?
There is certainly a place to describe to potential buyers what we term sellers' discretionary earnings is. Sometimes there are benefits to business owners which are not fully encapsulated in a business's financials nor taxes. And yes, there is certainly a place for that discussion and for documentation of those types of benefits. However, if you go too far in that direction, you're actually undermining trust in the discussion. Ultimately, buyers know that the relationship with the IRS is a very important one, and they want to feel that that business, especially if they're considering buying your actual stock and not the assets in the business, has been appropriately handled over the years. So my answer to that is there's a spectrum of right and wrong here, and Front Range can certainly help you figure out what the appropriate presentation of value that was generated for owners might look like and how to put that to a buyer, and what amount of it is appropriate in your exit planning of your financials to optimize for sale. The truth is that it needs work, and every business is slightly different.
Yep. That's great. Thank you. And in terms of sensitivity for taxes, we were talking about this in preparing these talking points for today's presentation. Certainly if you're working to minimize your tax liability, and your tax filings show one thing, which may be a depressed earnings picture for a particular financial year, because you did tax mitigation and you're approaching an exit, there is some forgiveness in terms of showing your kind of truest profit and loss relative to that tax filing. And what that looks like is a reconciliation statement. You can have a document that says, okay, well, there was a mitigated tax liability in that year that ended up showing much, because there was much lower earnings, which mitigated tax liability, and the actual earnings were more like, say they were $100,000 was your earnings that you reported, because that was much more advantageous from a tax perspective, but your actual earnings were close to $500,000. You can have a reconciliation statement that attends your P&Ls and your tax statements that you submit to the buyers and to the lenders that kind of clarify that. And they do understand that. They understand that tax mitigation is good governance. But if it shows a significant dip, and it shows a trend change for earnings and earnings, especially, like, it's just gonna beget more questions.
Let me chime in on that quickly.
Yeah,
those strategies, how they actually end up showing up is often in volatility of earnings. And it's just important to remember that first impression of consistency and reliability of earnings, which is the number one thing the buyer's looking for, to have volatile actual earnings undermines that. So you're balancing these tax benefits, which you may receive for yourself, with undermining the sense of the stability and non-volatility of your company's earnings. There's some middle ground that's appropriate for every business, and firms like yours help people figure out how to best narrative around that.
Yeah, thanks. Let's see, I'm looking through the chat here to see if there's any other questions we didn't address. Anybody have anything at this moment? Let's see. Yeah,
I mean, the hard ones.
Yeah, give us something hard. To accrue or not to accrue. I would love to talk more about accrual versus cash basis accounting, because I think there's an enormous amount of impact that can have on your ultimate valuation if you normalize your earnings utilizing that methodology, and kind of flatten and show those trend lines in a better way. If you're a bigger business, or you're a business that has a lot of commercial projects, moving to an accrual accounting procedure is going to likely have a really outsized impact on your valuation, we see. So something just to mention. But I'll just get back to this really quick. I really appreciate everybody's attention today and questions. Thanks for engaging with us. Thank you again, Hal. Again, we would love to have a conversation with you. We can do a introduction discovery call. If you click that calendar booking link, you can literally directly book with the president of our firm. I might join that call as well, or another one of my advisory colleagues. The exit tool is right there spelled out for you, the exit readiness assessment. Take that. That'll give us some information. That'll give, more importantly, you some information about where you are from a readiness perspective, and help us to start figuring out where those tailwinds and headwinds are in charting your exit strategy. And feel free to connect with me right there with that contact information. I'm happy to be of service to you. And thanks so much, everybody. Again, thank you, Hal. Have a good rest of your day, and enjoy the approaching weekend.
Thanks, everyone. Bye-bye.